Hey everyone, thank you for joining me today. This is our third quarter 2024 quarterly client webinar, and we're going to be looking at 10 themes that we feel may be kind of front and center going into the third quarter and maybe throughout the remainder of the year. By no means are these the only themes that we've been seeing throughout the year, but just kind of 10 main ones that I wanted to touch on. We'll also be recapping on one of the slides, just the asset classes performance for the second quarter as a look back and kind of see what brought us where we are today. So, and real quick, I want to say that I really hope that everyone in the Houston metro area that's watching this is safe and sound. Man, I really hope you guys have power by now and didn't sustain much damage. I know that was a horrific storm, and I've been here my whole life, and that was a doozy. So really hope that you guys are okay. This video was supposed to come out last week, and given the storm and everything going on, we didn't even have power at the building for a bit, and I know it's just been kind of crazy. So really appreciate you tuning in today and hope everybody is safe. So let's get into it. So our 10 themes for the third quarter are asset classes mid-year performance update. Not really a theme, but as I said, we're going to recap what occurred. We have our performance drivers, market themes. This is going to be kind of an interesting one. This is Nvidia's Meteoric rise, so you guys could get a kick out of this slide. Equity factors, inflation update, interest rates, the housing market, the U.S. economy in general, and then what we're monitoring in terms of high yield corporate bond market and new opportunities. So corporate earnings are forecasted to rebound, so it's a positive for the overall market and the economy. So we'll get into all of that. So as I said, we'll be recapping in terms of mid-year performance. So this slide recaps the financial market performance for Q2 2024. That's going to be your light blue bars here. And the first half of 2024, so the entire first half, dark blue bars. So right here. There are multiple trends to highlight, including a strong start for stocks, bigger companies outperforming smaller ones, which has been a constant kind of theme, and low bond returns, another unfortunate theme over the last few years. So in the equity market, the NASDAQ 100 and S&P have both gained more than 15% year to date. Again, this is through the end of the second quarter. And in contrast, small cap stocks traded lower in Q2, reducing their 2024 return to just 2%. So multiple catalysts may explain small caps underperformance this year. First, small caps are more sensitive to interest rates due to their reliance on short-term financing and floating rate debt, which causes their interest rates to reset faster. And second, smaller companies offer less exposure to the emerging artificial intelligence industry. So this whole kind of AI boom, it's not that smaller companies don't have any exposure there, but they just offer less. And so that was a major catalyst, and they're just not participating as much there. So this large versus small return gap is really part of a broader theme, that the smaller companies underperforming this year, which we'll discuss in greater detail in a later slide. But outside the U.S., international stocks have underperformed by almost 10% this year, despite developed and emerging market indices generating mid-single-digit returns. And then in the credit market, bond returns have been muted again this year. Investment grade bonds have posted a slight loss. That's here. I think my head is kind of blocking this for you guys, but those are a slight loss there. And high yield bonds have gained just 2%. So the difference between the two corporate bond categories is just due to yield. So the high yield bonds paying a higher absolute rate of interest, and then notably the high yield bond has remained stable despite the rise in interest rates, which we'll discuss more. I've got another slide on that as well. So while bond returns have been flat year to date, bond holders have experienced volatile returns, even though this is relatively flat. So interest rate volatility has remained high as investors position for the first interest rate cut. Only for the Fed and economic data to cause investors to change their views multiple times. So we're going to be talking more about this, but that's been a kind of a major theme throughout the year. When will the Fed cut rates? What's it going to take? All of those things we'll be diving into. So here we have some performance drivers, earnings growth versus valuation multiples. So really when it comes down to it, stock markets are driven by two main inputs. So we have earnings and then how much investors are willing to pay for those earnings. And so the two inputs are constantly changing, leading to rising and falling stock prices. So the two scenarios tend to cause stocks to trade higher, or the two scenarios that do tend to cause are positive earnings growth and investor willingness to pay more for those earnings. So the charts on this particular slide examine the S&P 500 through these two inputs. So the dark line in the chart, this kind of center line here that's darker. So this graphs the historical earnings multiple investors have assigned to the S&P 500. And this is going back 2 decades. The shaded region, so this area here that's kind of bubbled out on either side, shows the rolling valuation range. And so when the line is near the top of the shaded area, investors are willing to pay a higher price for earnings compared to recent history, which is, when you see the line kind of bumping up here, you're willing to pay more. When it's down in these areas or even low, you're not willing to pay so much. So today, the S&P 500 trades around 21 times. It's forecasted next 12-month earnings. So that's near the top. And so there's a practical limit, in terms of how much investors are willing to pay for those earnings and are unlikely to pay maybe a materially higher multiple. Now, there's a big caveat here. That doesn't mean that you can use this to time or say, hey, this is too frothy, time to get out. This can continue on for the foreseeable future, and things can change very, very quickly in terms of earnings growth and things like that. So it's good to know where we stand, but in terms of making moves just based on this, things have gotten out of whack, and so I'm going to get out, or things are undervalued, so I'm going to get in. Just remember that those trends can last a long time and turn on a dime. So although it's good to keep this in mind and know where we stand, trying to use this as a timing mechanism just doesn't really work. So, but if valuations are high, so what can really take the stock market higher? So this year, investors are more focused on earnings. So the chart on the right, this chart here, this graphs the S&P 500's earnings since 2006. So it shows that earnings were largely unchanged from mid 2022 all the way to the end of 2023, with rising valuation multiples driving the S&P 500 gains. So with valuation multiples near kind of this upper range today, you really need earnings growth to kind of take over here. So earnings are starting to rise, which is good. In the dotted line in the upper right corner, so this line we're looking at here, shows analysts forecast more than 10% S&P 500 earnings growth over the next 12 months. So investors will be watching to see if these forecasted earnings actually become a reality. But it is positive in the sense that, they are forecast to grow, and we kind of need that given where valuation multiples are in investor sentiment. So hopefully that will be the case, but something to definitely keep an eye on. So this is the kind of the fun chart I was telling you about, putting Nvidia's meteoric rise into context. So Nvidia has been a major story this year, along with AI in general. And if you didn't know what Nvidia or what company that Nvidia was before the year, you probably know now, or have at least heard of it. Before this year, or maybe 2023, I'm not sure that a lot of people even knew Nvidia existed. But they are a leading semiconductor company in the artificial intelligence industry, which is a good example of the dynamic between earnings growth and valuation multiples. So the company is obviously rapidly growing as demand for its computer chips outpaces supply. So this is because companies like Microsoft and Amazon and Google and Meta are spending billions on computer chips to train their AI models. So Nvidia's strong earnings growth has captured investors' attention, obviously, and so the stock has gained more than 150% year to date. Again, this is as of end of quarter. And now it fluctuates between being the second biggest and the third biggest holding in the entire S&P 500, and briefly actually surpassed Microsoft and become the biggest company in the world. But its rise over the past 18 months has been just extraordinary. So with both earnings growth and valuation multiple expansion, contributing to this rise. So what we're looking at here, this slide compares Nvidia's market cap against three well-known proxies to provide some context. So in January of 2023, beginning of 2023, Nvidia's market cap was just 400 billion. It was still a very large company, obviously, but I say it just because where it is now. But today it's around 3 trillion. It's just a staggering market capitalization. This is actually surpassing the entire market capitalization of the Russell 2000. Its market cap is over 3 times the size of Warren Buffett's Berkshire Hathaway, this line here. And so obviously Berkshire Hathaway is the famous kind of industrial conglomerate. It's got hundreds of companies in there. So this exercise has been really interesting, and it helps put Nvidia's rise into perspective. So in also today, Nvidia is trading around 40 times its next 12-month earnings estimate versus the average S&P company, trading at around 16 times. So while investors continue to debate whether the company is undervalued or overvalued, one thing is certain, and Nvidia's historic rise will go down in history books as a major event that impacted markets in 2024 for sure. And just to back up real quick, I don't know if I touched on this, but this line here, the total UK stock market. So this is literally Nvidia has surpassed the entire United Kingdom stock market in terms of its market capitalization. So just again, looking at this is just absolutely staggering. But it does help to kind of put things into context. So equity factors, the biggest companies continue to outperform in 2024. This is a good segue based on what we just talked about, Nvidia. So, obviously this is a notable story. So for the first half of 2024, outperformance of the biggest companies like Nvidia continued, and so this trend is evident across most stock market indices, regardless of market cap. Bigger companies are broadly outperforming smaller ones as investors wait for clarity around the economy and the Federal Reserve policy. This return differential has created a unique phenomenon in the stock market. So the chart on the left graphs a return gap between the market cap weighted and equal weighted versions of the S&P 500. So the market cap, just real simply, strategy allocates more to the biggest companies, while an equal weighted strategy allocates the same amount to each company regardless of their actual size. So the market cap weighted index has outperformed by around 10% through mid 2024, indicating the biggest companies are contributing significantly to the index's return. This is only slightly behind last year's 12% gap, putting last 2 years in line with 1998 and 1999. Is the last time we saw this massive of a gap. So the index's return is being driven by the biggest companies. So it's making it hard for the average company to outperform the index. So the chart on the right shows a percentage of companies in the S&P outperforming the index each year, and this is going back to 2000. So this year, only 24% of the companies are outperforming, the smallest percentage since the year 2000. So before this year, the lowest was in 2023 when only 27% outperformed. But on average, 49% of the companies outperform the index each year. So we're really low here. So the low percentage of outperformers this year has created a momentum rally as investors focus on this kind of narrow group of stocks to keep up with the index. So will this trend continue? It's hard to say. Not forever, I don't think, but obviously, we are in a fairly concentrated area here where very few of the companies in the S&P are actually outperforming. Let's look at inflation here. So we're going to kind of turn our focus to the economy, and this slide provides an update on inflation, which has been a huge driver of everything over the last few years, and discusses what the Federal Reserve is looking for to cut rates. What are they actually waiting on, and what are they looking for? Although they've been fairly transparent, when is this going to happen? So when are they actually going to start cutting rates? So it graphs the year-over-year change in the core consumer price index, CPI, which excludes the volatile food and energy categories. And so the chart shows the rise of inflation in 21, as the economy reopened from the pandemic, and then the peak in the second half of 2022. So we're kind of going from this pre-pandemic, and we see things spike up, and we peaked back here in the fall of 2022. And so this steady decline from the start of 23 to the first half of 24 is graphed here. And so we have our latest reading. So interest rate cuts are on the horizon with inflation trending lower. There's no question about that. But what will prompt the Fed to actually start cutting? So high interest rates have helped the Fed make progress, but officials keep warning that they want more data to confirm that inflation will remain low. And so we know that the Fed's target is 2%, but the Fed chair Jerome Powell, stated in a recent press conference that getting down to the high twos would be good. And so, central banks want to ease monetary policy to avoid triggering an unnecessary recession, and they believe a modest inflation overshoot in the near term is preferable to rising unemployment. And so the market's kind of left to figure out, will the Fed, how the Fed will transition from focusing on inflation to focusing on the risk of high unemployment. So, and we've kind of inferred from Fed Chair Powell's comments and other Fed presidents' speeches lately that 3% core CPI is the Fed's kind of dividing line, and if the reading is above 3%, the Fed's likely to consider waiting for more confirmation before cutting rates, and if it's below 3%, Fed is more likely to start considering cutting rates. So this is kind of where we stand. I feel like we're definitely close. And it may happen this year, maybe September, but don't hold me to that. Interest rates. So again, following that same storyline from the last slide. So more central banks are starting to cut interest rates. So this is a good sign for us, because not that we follow the rest of the world's central banks' direction, they tend to follow ours, but it is good to see that we're experiencing more cutting around the world than we are raising. So while the Fed waits for more confirmation that inflation will return to target, the global trend has decisively shifted away from tightening. So as we look at this graph, it categorizes more than 30 of the largest global central banks, and this is based on their last policy action. So either a rate hike or a rate cut. And the line compares the number of banks tightening versus easing monetary policy, with a positive reading indicating more rate hikes and a negative reading signaling more rate cuts. So right now we're decisively in this rate cutting environment as we see this line coming down. So the net cutting is obviously in effect currently. So central banks around the world initially cut interest rates early in the pandemic to protect against, unknown risks associated with shutting down, the global economy. And when the economy reopened and inflation soared to multi-decade highs, we had central banks around the world reversing course and aggressively raising interest rates. So their goal was to slow economic activity by increasing rates. This is one of their mechanisms to do that. And this has the aim of easing inflation. And so central banks kept interest rates high over the past few years while waiting for inflation to slow. And as shown in the plateau from 2022 to 2023. And fast forward today, and central banks are now beginning to cut rates as inflation slows. So more than 10 central banks around the world have cut interest rates, including Canada, Switzerland, and the European Central Bank. And the monetary policy environment is shifting from rate hikes to rate cuts. And so investors expect this trend to unfold globally into 2025. And so, however, this easing cycle is likely to be more staggered than prior cycles. So, we'll have different central banks cutting interest rates at different speeds, and this will be based on their unique inflation and economic growth situations. But the trend is definitely decisively cutting. So let's take a look at housing here. So this, obviously, housing market is a huge component of our economy and a big driver of things in terms of investor sentiment and just how consumers feel about their situation. So we're in this slide, we're providing an update on the U.S. housing market. It graphs housing starts and building permits over the past 5 years. So investors track the two data sets to gain insight into future construction trends and economic activity. Starting on the left, we see housing starts and building permits plunged early in the pandemic as the economy shut down essentially. So you see this, when I say plunge, you see this just straight down. And construction activity really rebounded in the second half of 2020 and into 2021 as the economy reopened. And so you see this spike back up. So as the economy reopened and mortgage rates fell to a record low at that point. And so housing activity continued to grow until early 2022 when the Fed started to raise interest rates. And that's marked by this vertical dashed line here. So we kind of see the rise and the fall. And so in 2022, the Fed's rate hikes pushed mortgage rates from 3% to over 7%, massive increase very quickly, and this caused a sharp slowdown in construction. And so here you really start to see this come down. So we have this rapid increase in building permits and housing starts, and then now we're seeing this kind of rapid decline. So a lack of existing home inventory for sale caused new home construction to stabilize in 2023, but the latest release showed housing starts and building permits both fell to 4-year lows in May of 2024. And so this is a continuation of the trend we've seen in early 2024 with residential construction slowing as mortgage rates remain high, and the slowdown provides evidence that the Fed's rate hikes are impacting interest rate sensitive industries. There's no question about it. And if you're one of those lucky ones that locked in just a crazy low interest rate, in the twos in some cases, how quickly are you going to want to, get back out there and sell your house and potentially have to refinance into a new house at a really, really much higher interest rate. Not many people are just jumping at the chance to do that. So all these things kind of factored together are really negatively impacting the housing market. It's going to take some time to work out. So let's look at just the economy in general and monitoring the economy on a weekly basis. So in the previous slide, we showed that interest rate sensitive segments of the economy are feeling the effects of higher rates. So what about the rest of the economy? So this slide provides the weekly economic index, which was developed by economists at the Federal Reserve, and this WEI provides a weekly index of real economic activity, and this offers a real-time pulse on the U.S. economy compared to the reporting lag of monthly and quarterly data. And so the WEI uses 10 daily and weekly data points like railroad traffic, retail sales, unemployment claims, tax withholdings, and electricity usage. And they use this to estimate real-time economic activity. So a positive reading indicates the economy is growing, with a higher reading signaling stronger activity, and contrast that with a negative reading signaling that activity is actually slowing. And so the chart shows the economic slowdown in early 2020, followed by a rapid reacceleration in the second half of 2020 and early 2021 as the economy reopened, and we can see that here. And economic activity normalized as the pandemic faded, but remained positive as the Fed raised interest rates. And so focusing on the 2024 portion of the chart, the index indicates growth slowed in early 2024. But, however, the far right of the chart shows the WEI recently started to rise in May and June. So this is signaling a potential increase in activity in the second half of 2024. Again, all these are very positive signs as the Fed starts to try to unwind the increasing of interest rates. Seeing the economy continue to put out strong readings is a very positive sign, and more hope that we may get out of this situation in more of a soft landing situation as opposed to a hard landing situation. So high yield corporate bond market, not the most exciting thing to talk about, but worth mentioning here. So in this slide, we're examining the current state of the high yield bond market. So corporate borrowers took advantage of low interest rates to lock in debt during the pandemic. And the chart on the left shows how this borrowing binge is still impacting the economy and market today. So it compares the average coupon rate on bonds in a high yield corporate bond index against the index's current yield. And so the bonds in the index have a weighted average coupon rate of 6.3%, which approximates the average interest rate borrowers locked in. But however, the index's current yield, a better reflection of today's borrowing cost, is around 8%. And so if a borrower wants to refinance today, the interest rate on the new debt would be closer to the index yield, or almost 2 percentage points higher. So this creates a potential refinancing risk or the possibility that the debt, the borrower is unable to repay the debt because it's unable to take out new debt. And so is this the big question here is this refinancing a key risk for markets today? Think of commercial real estate and all these things you've been hearing a lot about. Is this refinancing risk, is it really going to impact us? So the chart on the right graphs the percentage of bonds in a high yield bond ETF that mature each year. So we're over here on the right now. Only 2% of the bonds mature in 2025, which is great. Really lowers that reinvestment risk. 8% in 2026 and 14% in 2027. So looking at a few years. So borrowers face higher rates when they refinance. But the number of borrowers who will need to refinance in the near term is relatively low, which is great. It gives us time to get past this period, and we may actually see rates coming down over this period. So when they go to refinance, much less risk. So the high yield credit spread, which measures the yield gap between high yield and U.S. government bonds, remains very tight compared to historical standards. So the economies remain resilient despite higher interest rates, and default rates haven't risen significantly, contrary to what you may hear. And so we'll continue to monitor the high yield space, obviously, for signs of stress, but as borrowers refinance. But for now, really they have time to resolve any issues. There aren't a massive amount of these coming due in the near term. So all this, again, very, very good news. So here we're going to look real quickly at corporate earnings. So as we've said, kind of one major theme in this quarter's webinar has been the outperformance of the biggest companies this year. And this return gap has really caused investors to divide the S&P 500 into two groups of stocks. We have our Magnificent Seven, which I'm sure you're all kind of sick of hearing about. This is including, Microsoft, Apple, Google, Meta, Amazon, Nvidia, and Tesla. So kind of your major tech-driven companies, big tech, if you will. The remaining 493 companies, simply known as the 493, refers to the rest of the S&P 500. So in this slide, we are comparing annual net income growth for the Magnificent Seven and the remaining 493. So the 493 is this dark bar, and the Magnificent Seven is this lighter bar here. So in 2022, corporate earnings growth was negative, with both the Magnificent Seven and the rest of the 493 seeing their earnings contract. So earnings rebounded in 2023, with 493 actually leading the way. And this year, the Magnificent Seven is forecast to post another year of strong earnings growth, while the 493's earnings are forecast to be slightly positive. But looking ahead to 2025, the earnings gap is forecast to really narrow. And so the Magnificent Seven is expected to keep growing, but analysts also expect the 493 to post solid earnings growth. And this is what we need, is what we've been talking about. Given where valuations are, we need earnings growth to continue. So one theory is that the biggest stocks like the Magnificent Seven are outperforming because their earnings are growing more rapidly. But this reading, or this forecast, suggests that the other 493 stocks in the S&P 500 have been kind of overlooked and potentially undervalued. I think you can make a strong case for that. So it's only a forecast, but if the 493 grow their earnings in 2025, then smaller companies could make a real comeback after underperforming the S&P 500 so far, this year. And so that would be a nice turnaround and thing to see. As we've said, and I've mentioned many times throughout the years, what we would really like to see is, it's great that the markets are up and the Magnificent Seven is driving things, and obviously we are participating in that, and whatever drives the market drives it, and we want to be a part of that. But we do want to see a kind of the breadth of these returns kind of expand. We want to see more participation from these other 493 to really, I think, build in the ability to sustain this bull market, this rally. So it's good to see that at least there is a forecast for that to occur. Whether that occurs, only time will tell. Well, that is it. I really want to thank everybody for joining us today, and really hope this webinar has been insightful into market themes and things that we're following and keeping track of for you. So, and as always, really appreciate your trust and confidence in us to manage your wealth. And we couldn't do it without you guys. Obviously, it's the reason we're here. And please get in touch with us with any questions, or if you'd like to speak with your advisor, don't hesitate to reach out. And for all of you maybe tuning in that are not a client, we'd love to speak with you about your situation. Just reach out to us, give us a call, email us, and we'd be glad to talk to you. Again, I really hope you guys are safe and sound from the storm in this Houston area. And, let us know how you're doing, and we'll talk to you soon. Thanks, guys.